think it's safe to say this corn market has just been in a steady grind lower here for quite some time. However, we need to be prepared if this market could bounce. And typically that's what we see here as this September contract starts to work its way off the board. You get that late August, early September low and a potential bounce or rally into October, November timeframe. That's what we're going to take a look at here today. Keep in mind, everything we're talking about is for education and example purposes. Make sure you guys know and you're comfortable with your risk tolerance as we go through this information. Like we said, typically you get into that late August, early September timeframe, you're going to set some lows, and we wanted to look at what that potential bounce could look like. Now, we took the absolute low to the absolute high from 2014 to 2020. Here's our data set. Two things that are going to stand out right away. 2017 was an 11-cent move. 2020 was your largest move with $1.08. Now, keep in mind, that's from the absolute low to the absolute high. The likelihood of anybody catching that move is slim to none. But what we can do is put together some averages and some potential targets. So your median rally for that time frame was about 44.5 cents. Your average was about 52. So what we would say is it's probably reasonable that we could see a 10 to 20 cent bounce from where we are in the current market. Here's what this is going to look like on the chart. This goes back to 2013. The boxes are going to highlight that seasonal move or that pattern. One thing we do need to point out, if you look at the DEES 24 chart currently, it does look a little bit similar to that 2017 move, but nonetheless, we're going to have some targets sitting out there to see if we can't get a little bit of a late season rally here. So like we said, using that 10 to 20 cent move, we would target probably 410 to 420 here on the DEES 24 corn chart. And we start to bring in some moving averages and some price action, technicals with support and resistance. That seems like a reasonable target. Now, if we're using 410 to 420 on DEES, when you go to March, you're probably looking at 420, 430. If the futures market gets up there, that's where we want to be making some sales. Now, whether you do cash sales or sell the board or put fences on, that's entirely up to you and what you're comfortable with. But one thing when we look at these fences is if the March contract is somewhere in that 420 area and we could sell a 440 to a 460 call, is that a bad thing? And our bias is that if this market wants to run up and take out our call, we got to remember we're foregoing a 420 sale, getting called away later on at 460. We think that's a good problem to have. Now, there's going to be some margin associated with that, but at the end of the day, if we have higher prices, that's not only good for the crop that you currently have, but it's also going to give you some opportunities to market the 25 crop as well. On the flip side, when we're in these downtrend markets with carry, it's fairly common for front month to work its way back to where the previous months came off the board. So for example, if that September contract comes off at 360, we wouldn't be surprised to see DEES roll all the way back and come off near 360 as well. Ultimately, we want to be prepared. We want to look at putting the odds in our favor, sell the carry, challenge the market, and prove us wrong. If you guys have any questions, feel free to reach out to us. Don't forget to hit the like button. Don't forget to subscribe. And as always, we enjoy making these videos for you.